I want to reiterate the point. If you get interested in early stage investing, it's a long game, and you're going to fail a lot. And so be prepared to fail.
On this week's episode of the Silicon Valley Podcast, we sit down with Brian Bell, who's a managing partner at Team Ignite Ventures, who are early stage startup investors. Brian's had a long career from a director at Microsoft to AI global category lead at Amazon to startup mentor at Alchemist Accelerator and much more. This week's episode, we talk about the future of VCs, syndicate investing, safe notes, moving out of Silicon Valley, the future that AI has in early stage companies, and much more. All right, now let's start this week's episode of the Silicon Valley Podcast. Enjoy. All right, I'm very excited for this week's episode of the Silicon Valley Podcast. On this week's episode, we got Brian Bell. Brian, can you one, I'm a huge fan of everything that you're doing. I'm a Substack subscriber. Your brand and your marketing is fantastic. We're going to go into a lot of things today, but before we do any of the questions, before we go into that, can you give our audience a little bit of background of your career up until this point?
Yeah, thanks, Sean, for having me, and I appreciate the kind words. So I'm Brian Bell, managing partner and founder of Team Ignite Ventures. We're a small, kind of getting larger syndicate based here in Northern California. My career kind of looks like a wandering, meandering, lost squirrel in the forest looking for a nut. I worked really hard, grew up poor, worked really hard, to get to Wall Street, and quickly became disillusioned, washed out, kind of wandered around the world and jobs and trying lots of things, pivoting. Kept asking myself that Steve Jobs question, like, hey, if I don't like what I'm about to do today, like, I got to make a change, paraphrasing his commencement speech. And so I just kept making changes, right? And kept pivoting and found my way into tech. My first tech job, I was actually sharing an office with Instagram in South Park. I was working in solar energy at the time. When I came to San Francisco, like 2011, I wanted to work in solar. I was really, wanted to save the environment. And Instagram got acquired for $1 billion. I was like, that's interesting. The scale of software is pretty breathtaking. 13 introverted hipsters over there in that corner got acquired for $1 billion. And that's not why I got interested in tech. I was always like a tech nerd growing up, watching Star Trek. And I think I read Singularity is Near in 2005 or 6 when it came out, which the new book's coming out this year, which I'm excited about. And a lot of his predictions in that book, have come true, which is pretty breathtaking. But yeah, I just kind of wandered around tech, working at lots of startups, trying a couple of my own. Mainly built ad tech, martech, sales tech tools because I started in demand gen marketing after I moved off that solar company. Got really deep in AI, led the AI category for AWS, launched SageMaker Marketplace, marketplace for machine learning. And then Microsoft recruited me to lead all the categories over there at Marketplace. So I started up this team that basically recruited and scaled startups for Microsoft Azure. Turns out that was a great training to be a VC, investing Microsoft money into a bunch of startups and big companies, seeing which ones will grow. And then so I realized I was having more fun talking to founders. So I started angel investing on the side with my own money. At the time, Microsoft money had tripled, or the equity coming in from the offer they lured me away from AWS with. And, I invested in a bunch of venture funds. I was sitting on some investment committees for numerous funds here in the Valley. And I helped a friend of mine from grad school raise a fund, opening up my network for him. And I realized, I was having more fun doing this and I wanted to do more. So I started a syndicate, Team Ignite. Team Ignite now has thousands of members that can help ignite startups. We have 120 plus portfolio companies and counting. We're pretty high volume. That turned into a Y Combinator rolling fund, which I'm investing out of currently for this current batch, which takes up a ton of my time twice a year, going and meeting with 250 founders and figuring out the best 10 or 15 to invest in. It's quite the gauntlet. And then, so between all the syndicate stuff and the YC fund, obviously it built up enough of a kind of an income stream. You could call it that. It's not much money, but it was enough because I moved out of Silicon Valley during COVID that I could leave the cocoon of Microsoft and do this full time and take a huge pay cut, which I was very happy to do because I love what I do. So that was a long intro, but happy to unpack any of that.
A lot of questions there. I mean, anywhere from leaving Silicon Valley to the time at Microsoft. But I mean, one thing that you brought up that we haven't really covered too much of on this show in the past is investing in syndicates. Could you talk a little bit about your experience there with managing SPV, special purpose vehicles, and how did that work? How does best practices, some learning experiences that you've had in it for our listeners that might one day want to do that
Yeah,
or get involved?
I think if you're interested in startups, it's a wonderful place to get started. Typically, syndicates you can invest as little as $1,000 in an individual company. You can get a pretty high volume of investments going, depending on your financial situation. Obviously, this isn't financial advice or anything like that, but talk to your accountant and your lawyer or whatever. But syndicates
We got
are
that amazing disclaimer at the very end of the episode. We know everyone listens to the end,
yeah,
so
yeah,
we're good.
yeah. It was right at the end. Yeah, it's a wonderful way to get introduced to investing and start putting some of your own money on the line, right? Because you're going to make a lot of mistakes, and you're going to learn a lot. There's just so many things that can go wrong, and with these early stage companies, and it's a high mortality rate. And you'll be surprised when you start putting your own money on the line how wrong you were. And originally how I got interested in this, I think I read Jason Calacanis' book Angel, as many listeners probably have. Great book. I read it and I listened to it because he narrates it himself. So I recommend doing that. He's kind of a character. And he makes lots of good recommendations in that book. One is which is, you kind of for early stage, you need to do a higher volume. Typically in venture capital, they'll recommend that you concentrate, right? You want to concentrate to get the best returns. Well, that's when you're investing like Series A, B, C kind of startups, and you can write $25 million checks and you're Sequoia. When you're investing in pre-seed companies, they have, 80-90% mortality rate, where they return less than capital invested. So kind of need to do a high volume of them. One, to get, a lot of at-bats to learn a lot. And then two, to maximize your chances of hitting outliers, right? And so typically what I'll recommend to new angels is, okay, figure out what your budget is over a 3 to 5 year period. Commit to that. Typically it's 5, 10, even upwards to 20% of your portfolio. I'm overweight, obviously, because, I work in the industry. I'm probably 30, 40, 50% now. I was actually talking to a Citibank wealth manager. He runs the practice down in LA for all the wealthy people in LA, kind of the managing director down there. And he said he's recommending clients are at 20% now for alternatives. So that's higher than historical norms. But you basically want to have a budget over, this 3 to 5 year period that you don't mind losing, that you don't mind tying up for 10 years. And then you want to do, 20, 30, 40 per year across that budget. And
Let's go back just, the SPV itself. How is that set up? Have you managed those in the past? Like, what's this typical structure? What are some red flags or warnings that people should look at, think about, and any information around there to maybe fast track someone's learning?
Yeah, I think, well, an SPV fundamentally is just an LLC, and it's a special purchase vehicle, as you said. So you pool your capital with other investors and they go make the investment. Typically, it's run on a platform. AngelList is the leader here. Bacarda is another one. Sidecar is another one, where you host this SPV. Typically, you'll get commits and you'll raise as much money as you can. Typically, it ends up being about 100K, 200K in the SPV for a standard syndicate. In fact, on AngelList, it's 100K just to close one. You have to get to 100K because there's underlying fees and informing the entities and shooting out the K1s year after year and distributing the funds if there's an exit, all that stuff. There's just associated costs to cover all that stuff. Yeah, happy to dig into any particulars of SPVs.
Nah, I mean that was a pretty good overview, I think. How about let's go to the whole VC world and the VC landscape. I mean, how do you see that evolving?
Yeah, I mean, I think if you, I'm listening to Power Law right now as my kid plays lacrosse, and I'm just like, this is boring. I don't know what's going on. So I just listen to an audiobook and walk around the field like a meandering old man on the sidelines.
supporting your son the entire time, of course.
Oh yeah, just cheering him on. Good stick, you know. Um, but you look at the long arc of venture capital. I think it's a mature asset class. I it's debatable whether or not it'll be on par with like private equity in terms of its volume and its importance. I think the long arc of venture capital is more and more startups, right? So like, Andreessen said, software's eating the world. And you had a proliferation of startups in the last 15 years. That's why like angel investing even became a thing. That like syndicate investing wasn't really a thing before 10 years ago. Like you could do syndicates, but it's very rare and you had to kind of know somebody and it was kind of all custom, one-off kind of stuff. It was really when AngelList was founded, and Jason Calacanis, founded his syndicate that really became a thing. And it's really became a thing because of it's easier than ever to start a software company, right? And I think that's the long arc of history. And AI is just accelerating that trend where it's getting easier and easier. I saw a chart floating around the internet where it was the how many employees does it take to generate $1 million of revenue at Fortune 500 companies? And this chart is just going down. It's asymptoting to zero. It's down around for Fortune 500 companies now. 30, 40 years ago, it was, dozens of employees to generate $1 million in revenue. This is inflation adjusted. Now it takes 2, right? And so that's the leverage that we're seeing with technology. And I'm seeing it as an investor, right? You see 2-3 person founding teams with no employees and $1 million in revenue. And so it's just a different kind of environment where I wouldn't want to be a late stage investor right now. That's a really tough place to be, I think. Public markets are closed. You got a bunch of capital sitting there. Everybody's getting crushed by multiples and down rounds and cram down rounds. And early stage venture is thriving. It's a great place to invest right now. You're seeing companies with 3 or 4 million in revenue at 10 to 15 cap kind of valuations. So crazy amounts of traction with almost profitability coming out of the pre-seed or seed. They're basically like running this lean, and they don't really need to raise a Series A in some cases. They can just kind of keep reinvesting profits and cash flow, kind of like what Amazon did when they were scaling into the business. So I think the future of venture capital, what's changing right now is there's this new micro VC SPV kind of lead role, which I kind of fill in, right? The pre-seed is the new seed. And the definitions are changing, and there's a higher velocity of startups being created than ever.
With that being said, what do you think is going to be the big value add in the future of venture capitalists? And I mean, are we even going to see Series B or later VCs out there?
I don't think it'll go away. I mean, I think if you follow, I think it's just a changing of the velocity and amount at each stage. I mean, it follows that if there's 3 or 4x more pre-seed companies being founded, that they'll trickle down and have more Series B. So it's not necessarily a bad place to be. Right now it is though. In 2023 and 2024 to a lesser extent, pretty bad place to be. But I think there's just more than ever to fund, and so there's just a lot more need for pre-seed VCs.
Going back to that, I mean, where do you think the value add for a VC is going to be? And then also, I mean, do you think having a VC on your cap table, I mean, right now you got Sequoia, Anderson, some of these big names, people are just like, wow. Is that still going to be there in the future when,
yeah,
the 2-person team's a unicorn?
Yeah, I mean, and you can make a case, right? Like if you can have all these AI autonomous agents running beneath a handful of co-founders, like you can get 3 or 4 co-founders to get these autonomous agents, Chat GPT 5 or 6 or whatever it's going to be. It's not a question of if, it's a question of when. And there's these famous examples like Sam Altman and his friends are betting when the first $1 billion company only has co-founders or something like that. It's coming, and so more value is being created than ever. The value that a VC brings is a very existential question, right? Because I think historically, if you look at the history of it, they were very, very hands-on, right? Because this stuff was super risky. There was milestones. The VCs were rolling up their sleeves and sitting there side by side with these founders, trying to figure out how to go capture these huge opportunities. I think that's become less so over time. You certainly have, the innovations, like the institutional innovations of like A16Z, where they charge a little bit more management fee for their fund, and they have a bunch of in-house staff that can help you in any way that you can imagine. That's why, we called our firm Team Ignite, right? Is we wanted our network to help ignite startups. I feel like it's good branding, it's good positioning, because you're basically saying, hey, I have thousands of people who can help. And that's all a VC can really do. VCs don't have time to like roll up their sleeves and help you, right? They're not investing in 15 companies over a 3 or 4 or 5 year period like they did in the 70s and 80s. I'm investing personally in 50 or 60 a year. I don't have time to go like sit on board seats and talk through your sales and marketing funnels and stuff like that. I have a huge network of folks that can help, and I have preferred vendors and partners that can help you at every stage that you need help with. So I know who those people are, and I can connect you with the right people. That's, I think, the VC fundamentally, if you think about the essence of what a VC does, it's just, they're just super connectors. It's network, brand, deal flow, selection, and just being a super connector and connecting people to the right people at the right time.
It was funny. The other day, I had a conversation with a founder, and they asked me if they thought it was okay if they put on their pitch deck the AI tools that they're using instead of having employees. And I was looking at it going, what's the barrier of entry then for what's the special thing when everyone else can use the same AI tools? And the person's like, well, we just don't need money. That's the thing. I was like, to the same extent. It was just one of those moments when you're shaking your head going, not sure how to answer this. Like, what is the answer there?
Yeah, you're describing kind of the end of technological differentiation, right? And so because the AI is getting so powerful and more powerful than a single human in some cases, in some domains, and soon to be all domains, and more powerful than entire, companies full of resources, where you can spin up, dozens, hundreds, thousands of autonomous agents to help you run your business in any way you can imagine. We're going to see the rise of, single 1 or 2 founder-led companies that never raise any money, but create a ton of value for society, right? And it really just comes down to, now you're kind of looking at the founder. There's an execution risk here. There's a market risk. And will this founder move faster and break down walls better than other founders? It just comes down to sheer willpower at that point. And I think you're seeing this. I'm talking to other accelerators that work on, pre-Series A companies, help them getting to Series A. And they said, yeah, it's just willpower to Series A now. It's nothing special. It's just like, are you gritty and grindy enough to get this thing to Series A? Because you can do it if you really, really want to.
That's just crazy to think about. Whereas before, most areas, if you're geographically outside of one of these tech hubs, you had no chance. And now it's, as long as you got grit in it, that's crazy to think about.
Yeah. I timed my move out of Silicon Valley perfectly, right at the start of COVID. I lived right around the corner from you, down there in the peninsula. And my wife was like, hey, I think we should get a lake house, go away on the weekends. I was like, I think we can go live at a lake house somewhere in California, but I don't think we need to be here anymore. I was already working from my bedroom for years. I was on my 3rd company, including 2 big tech companies, Amazon and Microsoft. Like, why am I working from my bedroom in Silicon Valley? It's ridiculous.
So how is your move to the nice little area with a backyard?
Yeah, it's been amazing. Timed it perfectly. Obviously, real estate prices jumped up dramatically after we moved, but we got our offer in June of 2020, locked in that low rate a while later when rates kind of dropped. And now we're kind of, like many homeowners in that situation where, we can't move because not only have homes doubled in value, but rates have more than doubled. And so our housing costs would more than double. But it's wonderful. We're on a lake. We got deer in our front yard. We got a big backyard. The kids, kids love it here.
let's go back to what was mentioned earlier about, VCs at one time invested in 15 companies, but you're going 50, 60. How do you communicate with all your portfolio companies? How do you manage that? And what are the best practices for founders out there to communicate with their investors? Maybe not so much their board, but the investors on their cap table. What would you recommend for updates, information shared, things like that?
Yeah, I think there's a few things. I'll start with the founder side. I think regular, consistent communications about the business, the health of the business, financial metrics, what's going well, what's not going well, and what most importantly, where they can use help, what the asks are, and the asks should be very specific. It shouldn't be, "Hey, I'd like to talk to doctors." Okay, like I probably know some doctors. Um, oh, I need to talk to family physicians that work in mid markets that run their own practice. Okay, that's very specific now. Okay. You want to be very, very specific and include like LinkedIn links. Again, going back to the super connector of the VC, the best thing they could do is introduce you to people that can help, whether it's potential customers, market feedback, other VCs for fundraising, people in their network to help guide you on setting sales processes or hiring your CTO or whatever it is. Be very specific, use LinkedIn links. Say, I need to talk to people just like this, and use a sales nav search or a LinkedIn search. And then inevitably, I'll pull that up and I'll be like, okay, yeah, there's 10 or 15 people I can introduce you to, but which ones look good to you? So being very specific with what you need help with, and specifically on what's going on with the business and what you're going to do about it. From the VC side, as a high volume investor, I mean, it it's a still evolving process for me with 120 portfolio companies. I mean, obviously I have a big Google sheet with all the statuses, last time I heard from them, who the founders are, what their email addresses are, what's the current mark to market, burn, runway, things like that. And so you're just trying to keep a tab, at least on a monthly basis, of what's the health of each of these companies, where do they need help, and where can I help? When's the last time I heard from them? Oh, I haven't heard from you since November. Oh, that's a red flag. What's going on? Usually they'll stop communicating when stuff is going bad. And so yeah, just keeping tabs on that. And it sounds like a lot of work, but even with 120 companies, I'm not meeting all of them every month. I'm reading their updates, seeing where I can help, and then I have a personal assistant as well that I can, subtask a lot of this stuff too. I want to go talk to these 5 people. Great, my assistant will make those intros.
Speaking of companies that you haven't heard from in a long time that you might be warning flags there, why do you think it is that, well, when things go bad, I mean, I can kind of understand why they don't want to talk to their investors, but also, how come it seems that they always wait to the very, very last moment to prepare for an exit? And I say that from the point of view of
Yeah.
an investment banker, where I'll get these companies that will come to me. Literally, just this last week, I had 2 that were saying, "Hey, we have a week left of money. We need money now." And you're like, "How? What? Like how? How'd you get in this spot? And how do you think it can be solved in a week?" What are your thoughts on it?
Well, I think if you look at a founder, you got to be crazy optimistic to be a founder, I think. Right. And so you're always believing that the thing's going to work out. And I think when things start not working out, you're like, okay, just it's around the corner. I'm going to turn a corner. I got 7 months of runway. I'll figure something out. I got 5 months of runway. Getting worse, but I'll figure something out. And then all of a sudden you have 1 week, like you're describing, which is a very extreme example, right? We're gonna have to send everybody home next week. So I think founders get in denial about how bad things are. And I think if you're down to about 8 to 6 months of runway, and there's no round forming, like if you don't have half of your next round committed by the time you get to 6 months of runway, you have to start trimming right away so you don't run into a wall. And so a lot of founders will just run into that wall. They'll just kind of keep the burn at 80,000 a month, 200,000 a month. They got 6 months of runway left. Things will turn around. You don't want to admit that they won't. You have to start making cuts. But it's also, there's there's so many things at play in being a founder, and I've been in this situation as an entrepreneur as well, where, something's not working out and you have to start laying people off. It's not fun, because now you're killing the culture of your company, right? Because everybody's like, well, if he's going to lay people off or she, I might as well leave as well. So your star players start leaving as well. So it's a complex thing, but you always want to be raising from a position of strength. You want to be able to call people like Sean when you have 6 months of runway left and be like, hey, I just made a massive cut. I took my 6 months runway, extended it to 12. Here's my plan for this next million or two that I need to raise. Here are the milestones that I think I can get to. And then you want to be able to get to default alive if need be, right? And there's no excuse, right? If you have 1.5 million of ARR, let's call it, that's 100,000 a month, over 100,000 a month of revenue coming in. If it's a software business with high margins, you should be able to get to default alive. If you have to, you should never run into a wall and have to shut down the company.
Say you have to shut down the company. I mean, with all the investments you've had over the years, I'm sure it's happened quite a few times. From the investor side, what happens then when you have to communicate to your LPs? What happens for tax purposes? What happens to the returns report? Like, what's going on in your mind as the investor when a portfolio company that you'd backed that you're so hopeful is no longer around?
Yeah, and typically you don't really run out of cash. You realize it's not going to work out, and you give up. That's what I've noticed in my portfolio. And I've only had 4 shutdowns over 6 years. And they tend to be, a founder left, so now I'm a solo founder. Or it's consumer, so it's really tough, right? Really tough, low margin. Consumers are used to getting stuff for free. So the conversation usually goes something like this. I remember one in particular. I'll just give you a story. I see the updates coming in every month, and there's not a lot of progress being made. And so after the second or third month, I go, what are you guys doing to grow? It's just a simple question like that. What are you guys doing to grow? Because you're not growing. And then it was kind of like a conversation back and forth. And long story short, 2 or 3 months later, they shut down. Because I think they realized they were just, they were Google engineers. And so they just weren't hungry, go after the market kind of entrepreneur types. And they were just happy kind of milking that, $2 or $3 million raise and just kind of collecting their salary and just doing their little research project for their little startup. And they weren't the hungry break down walls. I will do whatever it takes to get to Series A kind of entrepreneurs, right? And so usually it's like, okay, we're going to shut down the company. And then it's just a series of legal conversations about returning capital and who gets what. And, so in that SPV, this was an SPV, we originally invested, I don't remember the exact number, but let's call it 100K. I think they returned 60K of capital. So now all the investors in that SPV lost 40% of their capital. And that's the nature of startups, right? If you look at the stats, 80-90% return less than invested capital, especially at the pre-seed. So it's very, very risky, but it's also very asymmetrical, right? You can only lose 1x of your money. In this case, you only lost 0.4x. But on the other side, you hit the next Google and it goes 400,000x, which is a complete it's power law asymmetry. And
then, I guess when you report to your LPs in that kind of the monthly, quarterly newsletter or information or that, how granular do you go with all the investments, or is it kind of a general overview of the fund, or what's kind of typical for pre-seed, seed?
You got to be careful. Yeah, you got to be careful. You don't want to give away everything that the startup is sending to you. You don't want to, in particular, I don't usually send financial data unless it's an individual SPV. So on individual SPV, there's only 20 or 30 investors. So it's pretty controlled and it's very confidential. And here are the financials of the thing that you invested in. Because you can think of it like an SPV, a fund of one company. And, these 20 or 30 investors have, on average, 3,000 to 5,000 each in the company. It's their own money, right? So I'm going to share pretty much everything I get from the founder. But then there's like a fund newsletter, right? Which might have dozens of companies. You're very careful because that There's just more companies, more LPs. It depends on the audience, what it's going out to. You can be general, like, hey, revenue growth looks strong. They're struggling with integrating a new partner, and they need help, talking to, blah blah people. So you kind of don't get into the nitty gritty details in many cases, but you kind of keep it at a high level.
Okay, now one thing that you're doing that's very impressive is your social media, your outreach, your newsletter. Can you talk about that? Because I mean, I'll be honest, a lot of VCs are not the best at marketing themselves, but you're everywhere.
Yeah, thanks. Well, I think, I ran marketing demand gen teams, right? So I've done marketing demand gen in my business. I built ad tech, martech, sales tech tools. So I'm just familiar with the space. And then most of being a VC is just having a brand, right? And just being out there and coming on amazing podcasts with guys named John. And,
There you go. Nice plug. Thank you.
writing articles about what you think, right? And just showing face and just being out there and just having a constant drip of content. And my content's gotten better over the years. It's better than it was. It's still not great. I could do better, but I just try to I keep a running log of things like that I want to talk about. I have a little Google sheet called my post queue. I just released an article called, Be Safe Out There, because I've seen a lot of weird modifications to safes over the years, which are simple agreements for future equity. It's like kind of the standard pre-Series A, security that you invest in. But people are modifying them. And, I just had this idea like, hey, I need to write an article about this. And so I'll have I have like 100 article ideas that I want to write about. I don't have time to, sit down and write an article every day, but I try to do one or two a week.
What are some of these modifications on these safes? I'm curious.
Oh, it gets pretty crazy. You'll get all kinds of weird terminology. You get a lawyer in there, and they'll just invent all kinds of weird stuff. And so you want to always, the lesson there is try to always invest in a unmodified YC safe. If you're looking at SPVs, you kind of want to know what the underlying safe is that you're investing in. A lot of times there's a lot of assumptions. Oh yeah, we're investing in a safe. It's safe, right? It sounds safe. It's safe. But you look into it. That's why I called the article "Be Safe Out There," because you look into it, it starts to in certain situations it converts to common. Well, you don't, as an investor, want to be converted to common. You don't want to sit down there with the employee option pool. Like, you want to be up at the preferred. So like if the company goes out of business, you get your money back. In that example where the company returned 60% capital, if I would have converted to common, I would have got zero back from my investors. Because the preferred would have taken everything before any money was left over for the common. And that's after paying all the debts and all that other stuff. So, and there's lots of things I outline in the article that can go awry with safes.
So when is this article coming out? Is this going to be one of your viral LinkedIn post that gets hundreds of thousands of views?
I just released the article last night. I won't do the social post for a while because it's sitting in my buffer queue. But it'll come at some point. Yeah.
All right, we got a few minutes before wrapping up. Any stories, any lessons you want to leave our audience?
Oh, it's such a broad general question. I think, I want to reiterate the point. If you get interested in early stage investing, it's a long game, and you're going to fail a lot. And so be prepared to fail a lot and have a budget in mind, because the last thing you want to do is when you start looking at startups, you're going to get excited about everything because everything looks amazing, right? Especially if you're just sitting in your cushy corporate job and start looking at these amazing startups. Like, oh, that'll work. Most of it won't work. And so you kind of want to have a budget over a certain period of time to dollar cost average into this asset class. Kind of like, with stocks, right? When you look at investing in stocks, the general advice is don't concentrate, don't buy a margin, buy a basket of 20, 30 good stocks over a period of time. You get enough diversification to protect yourself. Now, that's a different message from most VCs. Most VCs will tell you concentrate, have high conviction, put all your eggs in a few baskets. think it's just bad advice for early stage. I don't recommend you do that. You want to have. And this is not investment advice. Again, you talk to accountants.
How many disclaimers are we gonna have to have?
Yeah, exactly.
Episode.
But yeah, have a budget. Have a budget and invest over many years, and just be a student of startups. And it takes time to get this right. And that was advice one of my friends gave me. I always thought I'd start investing in startups as a retiree or something. I was happy climbing the corporate ladder, and if you probably should get started, you're going to make a lot of mistakes. And that was like the best advice, because I've made a lot of mistakes with my own money. So far, so good on other people's money, because I was investing some of my own money for 2 or 3 years before I started investing other people's money. But yeah, when I got started, I was writing huge checks, $25K at a time into startups. And in hindsight, that's way too much money for a single investment, unless 25K is like nothing to you. But for me, that was a good portion of my startup annual investing budget.
It's kind of crazy. I remember this one time I was in an angel meeting, and this one guy, this was one of my first meetings ever. And the guy heard a pitch, wrote $100,000 check, just handed to the guy. And I was just blown away. And the person sitting next to me would just go, Sean, that guy writing $100,000 check is like you buying a burger. I was like, oh. It's like, gotcha. Okay, I understand it now.
And that's why you want to make a high volume of checks, because you look at something like Jason Calacanis always talks about his Uber investment, 25K turned into 250 million or something like that. Went whatever that is, 100,000x. If you would have put 10K, it still could have been a really great investment. Would have turned into 10 million. So you kind of want to take enough shots on goal to, you miss 100% of the shots you don't take, right? So you want to have enough shots on goal to hit something big.
All right, Brian, if anyone wants to find out more information about you, what you're working on, what's the best way to go about doing it?
Well, you can go to our placeholder of our website, teamignite.ventures, teamignite.vc. It's admittedly, it needs a lot of work because I've been just busy investing money. But yeah, you can go check us out there.
All right. And we'll have that link in the show notes. And for our audience, when I'm not the host of the Silicon Valley podcast, I'm an investment banker focused on mergers, acquisition, growth, capital. Connect with me on LinkedIn and go to the SiliconValleyPodcast.com to check out our archive of episodes and for what we're working on. And with that, Brian, this is a great episode. I want to thank you. And I want to remind all our audience, this is not financial advice. And that if you're listening to the end, and we have our little disclaimer right after this. So Brian, thank you for your time today on the Silicon Valley podcast.
Thanks, John. Thanks for having me.